Hello, this is the Chartprofit Webcast, approaching 3.5 hours into the trading day on Friday, 22nd of May. This is from today's pre-open. Just over a week ago now, the 10-month control price migrated to 20.95.50. That's the important level to monitor. Let's look at the auction chart for the E-mini, and this is the bar chart, daily bar chart for the E-mini, with significant buying and selling marked as red and green. Here's 2045, previously the point of control, and then here around May the 13th, with time in here, this migrated higher, the point of control, a controlling price, migrated up to 20.95.50, and price action since then has been pretty positive. Said at that point over a week ago that when an important point of control migrates, often just precedes a directional move. It's kind of a shift in the control, which in this language has shifted a lot of the sellers to the buy side, and that's why my hunch was higher here. But we did see at that point on Monday aggressive buying marked above that level, which was here on the chart, but also seen it on the previous Thursday in here, this green bar here. So in the longer term, as I've said, above 20.95.50, as long as we spend time up here and don't see any price action like this, the E-mini will remain in a strong price location. And pre-open yesterday and today, we're talking about the day frame here. So in the shorter term, we're looking at a very minor level, 21.23.50, as just the level to watch intraday. And actually we saw an open yesterday just below that level, which was rejected. And actually intraday today, we're looking here at a 5-minute bar. That level 21.23.50 has been very clearly support. So in the really short term, we can monitor that level. Price below there, I think there's likely to be volatility a little later on today. But we haven't seen the range extension I was talking about. If we look here on the weekly bar for this week, the lows here, the highs here, it's a tiny bar when compared to an average. So we were expecting basically extension of this range, either higher or lower. My idea was as long as we remain above 21.23.50, it's likely to be higher. We're ahead of the holiday weekend. It's possible the market will stay reasonably quiet and we won't see that range extension. Okay, pushing on, this is the daily breadth chart for New York. Two most important indicators down here on the right. The percentage of stocks greater than their 50-day moving average in the New York list, above 50. And my indicator, the net new high, is 25. 5-day moving average in yellow above the zero line. This is what I call supportive breadth. And on the pulse chart, this gives us this green area here on the breadth in the middle, which is positive. Price momentum is positive and actually heading higher now, so that's a positive. And we remain above 207.92, which is the 8-month time support, and that's pretty much supported it 3 times here throughout April and May. Market getting a little overbought, but we're looking for this breakout to hold here. In the longer term, as long as the spider holds above that level, it's in a strong price location. While we're looking at breadth, this is a template I set up in my Metastock Pro. Blue line at the top here is a 10-day moving average of the advancing issues in the market. The red line is a 10-day moving average of the declining issues in the market, the spider underneath. So obviously it's better to see the advancing issues moving average above the declining issues. We can see these numbers sort of intraday, and today they've moved slightly back towards each other here. So it looks like there's more decliners than advancers here. Also keep my eye here on the market advanced decline line at the bottom for the longer term, again with the red line being the 10-day moving average. Especially useful to watch for divergences between the advanced decline line at the bottom here and the market at the top. So if the market breaks out, for instance, up here as it has done, we really want to see that advanced decline line confirming that, which hasn't quite done, although currently it still sits above its moving average. So I'm really looking for that to pick up. But it's a nice little template when you combine the two sets of indicators. Have a quick look at the index ETFs. This is IWM, the Russell 2000 ETF. up quite strong at the start of the week, above its previous resistance here, which was the half range off this high and the subsequent low. So this is a strong price location in the short term, and as long as it holds above 122.35, which is the local point of control, it's a strong price location. Diamonds here also attempting to break out here. Looking at the supporting charts, this is the T-bond ETF, TLT, 12-month point of control at 119.26. Probe down into that, currently just printing just above it. There's bigger support down here at 117.14, which is the major point of control. There's a big band of support here. Price below that would indicate major weakness for this chart for bonds. GLD, we talk about this each day in the pre-open, and as you know, first level resistance on this chart is from this low back here in November to the subsequent high, which comes in here, the natural resistance on the chart, as in April, early April. And again in May here, looks like we've rejected that resistance. The support now, the 18-month point of control at 115.12. So we're kind of in no man's land here. Price below 115 down here would suggest a retest of the low to me. Price back above this halfway point, just below 118, would suggest a move possibly back up to test that major point of control again. Currently the dollar, which we'll look at now, suggesting possibly we're going to see some more weakness in here. So gold may be interesting below the 115 level for a short down to here. So we'll look at the dollar. This is the index. Spent a little time here below the 12-month point of control, but we're back above it now and printing the highest level in May so far. So it's been a bit of a change this week. The dollar has come roaring back in terms of price location here and there, certainly on the index chart. And we'll just run through a few of these. This is the Aussie dollar back below spot 79.25, which is a major half range level here. So this is a weak price location, which suggests, if it stays that way, a test of this level, which is the major point of control, which was support here and here. I mean, this is a really major level off the monthly chart. Price down here would suggest extreme weakness, but just in the short term right now, a little bit weaker than we were earlier in this week. So strength for the US dollar in this chart suggested. The Aussie dollar chart was a daily chart. This is more useful to look at for the pound dollar. This is a weekly chart, and we looked at these levels last week, the major half range just above last week's high, and the pound has turned down off that obvious resistance. And if I zoom in here on the daily, there's the two levels at the top here we were just looking at, and this week with just a little bit of time spent in here, the 12-month point of control or time support resistance has migrated to 156.70, and that appears to be turning this chart lower. So longer term, there's a lot of resistance up here to the chart, and first level to watch 156.70 next week. But again, some weakness here, therefore implying some strength for the dollar. And on the Euro FX chart, very similar. 12-month point of control up here. The major, as we know, at 1.23, and this blue line is a major half range. So to my way of looking at things, again, the Euro in a weak position here, which implies strength for the dollar again. Finally, the dollar yen. Dollar in strong position. This level here at 119.64, that's the 12-month point of control. It's actually migrated a little higher this week, and the major, as we know, at 117.68, a little lower. So this is strong price location. Again, you'd be looking for, that's not well drawn, but we're looking for a breakout above these previous highs here. So going into next week, the dollar at the end of this week looks pretty strong. Okay, I'll finish with the sentiment indicators. We're looking here at the my version of the Ridex assets ratio. As I said, pre-open on Tuesday, hit a 4-month low in here. If we look at the bull fund assets in isolation, recently, I think last week, hit a 6-month low. Well down from its previous, well, its high, actually, extreme high back in November. And again, looking at the bear fund assets in isolation, just a few days ago, hit a 5-month high. So just back to the ratio, as the market's pushed higher here, generally the indicator has come lower, the ratio has come lower, indicating that the retail traders, the Ridex traders, are a little fearful and wary of this breakout, which in the short term from a contrarian perspective is reasonably encouraging. This is the investors' intelligence this week. The bulls percentage was slightly higher at 50.6, up from 47.5. That was actually a 6-month low. That was the previous week's reading. So bulls percentage up, but from quite a low base. Bears percentage unchanged. Should the market break out and move higher, we'll probably see this 4-week moving average of the net moving back up, and we need to be watching for that sort of price action, chart action. Exposure index, that's the equity exposure of active money managers, came in this week at slightly higher at 67.61, but if you remember previous week's 60.38, that was a 6-month low. Again, from a contrarian point of view, that's reasonably encouraging. From Lipper US fund flows, they reported equity fund, including ETF, outflows this week of 1.7 billion. So there's a 1.7 billion dollar outflow in the week to the 20th of May. The 4-week flow in yellow here, down in negative territory. So nothing extreme for smart bulls, let's put it like that, to worry about here. Looks like we have fuel in these contrarian sentiment indicators. In the public poll from AAII this week, the bulls percentage fell to just above 25%. So this is actually just looking at the bulls percentage, this chart, bulls percentage being the blue line at the bottom here, and at the chart at the top, the spider on this weekly chart, just showing these blue arrows where the bulls percentage dips below 26%. And as you can see, usually that low level of bulls in the data indicates that the market is usually ready to move higher, at least for a few weeks. But we'll dig a little lower, a little deeper into this data. So in this chart, I'm actually looking at the bottom here, the red line, and that's the bears percentage. The blue lines at the top still representing the bulls percentage, less than 26%, and you can see the arrows here. But you'll notice that in all others situations here, back for a few years, where that's happened, the bears percentage has been quite high, above 45%. Okay, at the moment that's not the situation. So we've got a low bears percentage along with a low bulls percentage, both around 25%, indicating that the neutral reading, or people unsure and not willing to give themselves a directional bias, must be around 50%, which indeed it is. This is the neutral percentage from that data, and you can see it's up here, and that's extremely high. So indicating not many bulls at the moment, not many bears, and not many investors willing to declare themselves in that fashion, but an awful lot in the neutral camp, undecided. So the way to read that, I think, is that the bulls percentage being this low is not necessarily a big contrarian bullish indication right now. There appears to be some encouragement from the sentiment. I see the breadth as pretty positive at the moment, price momentum picking up, so the technicals all look pretty good, and the price location, even on the minor time frame, 21.2350 is the level that we've been watching over the last couple of days, and that seems to be support today. So let's see how we close relative to those levels this week. I'll just once again wish you a good extended weekend break, and once again thank you for watching.